Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Martins Marnauza, Investment Partner, Origination and Execution at Coller Capital in London. Welcome, Martins.
Thank you for having me, James.
It's a great pleasure. Martins, what makes private credit secondaries such a fast-growing asset class? It seems that since 2021, it's taken off massively. Is that just a function of the growth of the primary market in that time?
Yes, you're absolutely right, and I share the sentiment. It's been on a geometrical progression, and we would expect it to stay on the trend. But you're absolutely right. There are two key drivers for the growth. There's the organic and the structural. The organic being the growth of the underlying primary market, and from what was a few $100 billion in private credit around the GFC time, that's grown now into a few trillion of primary private credit market. And secondaries is, at the end of the day, just a function of the primary market. And private credit and senior direct lending in particular has been one of the bright spots in the last few years in terms of fundraising. So the primary base keeps growing, and with a bit of a time lag, that will generate the transaction volume on the secondary side. So that's the organic, and then the structural is the percentage of primary that converts into secondary transaction flow. And the private equity secondaries market is by far the best precedent we have for observing and extrapolating what might happen on the credit side. And for private equity, the annual churn has been around 2% historically. For credit currently, it's well inside 1%. So the dedicated capital that's available for private credit secondaries today would not cover a full year transaction volume. So we're in a treadmill, constantly raising and deploying at the same time.
So you see private equity as a strong precedent, but do you see the private credit secondaries market following the exact same development path as the private equity secondaries market, or do you see private credit as being differentiated and even being a completely different animal?
There are more similarities than differences. When I joined the firm, the total transaction volume in 2010 on private equity secondaries was less than 20 billion. Last year, the same figure was around 140 billion. So it's been on an exponential growth, and we would expect the private credit secondaries very much to follow the same trend line, but at an accelerated pace. And the reason for that is that ultimately it is the same set of drivers behind the transactions. It is the same stakeholders in terms of investors and managers and advisors. It is the same type of transaction. So it's a technology that's been well tested and proven on the private equity side, and it's being transitioned and adopted on the private credit side at a very quick pace.
How do macroeconomic effects in the primary credit market flow through to the private credit secondaries market, and how quickly does that process occur?
It would be primarily the base rates and the duration of the loans. So for senior direct lending secondaries in particular, the underlying loans, the vast majority, are on a floating base rate. And so any changes in those base rates then directly affect the cash yield on the loans. As things stand today, we're probably back to an environment of higher base rates for longer. And for private credit, it has generally been good news in the last few years because the cash yields have increased, but but the credit performance has stayed intact. We haven't seen as many losses as one might have expected. So that's the base rates. And the second is the duration, and that has to do just with general activity, M&A activity and public market activity in the market. The expectations for this year were grand, that the M&A market will reopen and the public market will become very buoyant again. Given the uncertainty today, I think some of those expectations are falling away, so the duration will probably get extended, i.e. the investors will have to hold on to the assets for a longer period of time, which is great news for secondaries, because if there is no natural monetization of the assets, then that's where the secondary strategy comes into play to generate early liquidity.
How does Coller quantify to investors what the firm believes are the growth prospects for the private credit secondaries market?
Well, my personal view is that the private credit secondaries market should be the same size or larger than private equity secondaries market by 2030. And the reason I'm saying that is because the size of the underlying primary market are comparable. Structurally, like I mentioned earlier, private credit is still catching up. But long term, it should be, in comparative terms to private equity, a more efficient, a more liquid market, and hence higher volumes.
Take us through what a continuation vehicle is in the private credit secondaries market. Is it exactly the same as a continuation fund in private equity secondaries?
Pretty much. It's the same technology. It's often the same drivers behind a transaction. A continuation vehicle is a wholesale liquidity option, and I'm emphasizing option, that's organized by the manager for the benefit of its investors. So the investors are given the option either to cash out or to roll and continue into the next vehicle. The assets are being lifted out of the existing fund, put into a new vehicle. The new vehicle has a new term. It has a new set of economic arrangements. It might have additional capital that's being brought in to support the portfolio companies, etc. Again, it's a technology that came to fruition on the private equity side only about 7-8 years ago, and the inflection point was the large blue chip household GPs engaging into continuation vehicles as a type of liquidity route on their assets. And so I feel last year for us was an inflection point, and this is all public information. Guggenheim, Abry, Vista Credit completed their transactions, and as we're looking at the pipeline today for private credit continuation vehicles, the pipeline is extremely busy, and it's 500 to 1.5 billion size transactions by household managers.
One of the things that's got great traction at our events where Coller Capital has presented, Martins, telling the private equity secondaries story, has been this idea of you come in later with secondaries, you're not taking blind pool risk, you've already seen how some of the assets are performing, you buy in at NAV, it's quicker for the investors to receive some liquidity. Do all of those attributes hold true with private credit secondaries?
Absolutely. So the key reasons to invest with the strategy, the key benefits of the secondary strategy are exactly the same on the private credit side as they are on the equity side. You mentioned the seasoned assets that we're acquiring, and that's a key characteristic in the strategy. We're able to touch and feel the assets before we acquire them. The assets tend to be quite seasoned, mature at the point where we're acquiring them, so the remaining life of those assets is shorter. The de-risking takes place quicker. Diversification is the holy grail in secondaries, and again very dominant as a characteristic in private credit, even more so than in equities, I would say. In the evergreen vehicle, for example, that we have for private credit secondaries, it's been in operation only for about 6 months, but on a look-through basis, we already have more than 3,000 loans. So no single loan matters. The unsystematic risk has been completely removed from the equation. But the cherry on the top really is the discount in secondaries. And so if it's a primary new loan underwrite, those loans will be created at 98 cents. We're acquiring the same loans at 85 to 90 cents. So it gives us a margin of safety out of the gate for any kind of volatility that might come in the future. And it also provides us with, unusually for credit, a positive skew towards the upside as we capture the discount, that pull to par that takes place from when we acquire the assets at a discount to when those assets repay, typically at par. So the private credit strategy is not a momentum strategy. It's an all-weather investment strategy. Sleep well. It would typically form part of the core portfolio for any institutional or private investor.
And what's interesting for the advisors that are our audience, Martins, in that wealth space, it seems that secondaries have made or given or provided liquid access to what formerly had some strong investment attributes, but was probably going to be illiquid. So it almost seems like the best of both worlds. What is the catch?
There is no catch. It is what it says on the tin. We are generating premium returns for providing liquidity on what otherwise are illiquid assets. And I can't emphasize enough that the assets we're acquiring are high quality, well-performing assets. So the notion of a discount is not reflective of the quality of the assets. It is reflective of how we're capturing the value of the liquidity solution for the sellers.
It's fascinating stuff. Thank you very much. This has been INDepth with Martins Marnauza, investment partner, origination and execution at Coller Capital in London. Martins, thank you so much for your time today.
Thanks for having me.